Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
Welcome to the Trading with Venus podcast. I'm your host, Raman Gill. So today we'll talk about how to profit from market correlations in Forex. We have covered parts of this before, but I thought we'd just put this together in more of a comprehensive way. So let's dive in. Just a quick disclaimer before we get started. This is for educational purposes only. Trading is a risky business, so please be careful with your money. Like I said, today we'll talk about market correlations, and we'll take a look at how the different correlations impact our Forex trading and how can we really benefit from this intermarket correlations. So what are a correlation? What is a market correlation? First of all, the definition of it. Correlation is basically how much two different securities or assets will move in relation to each other. That is the definition of correlation. So how much one asset moves in relation to the other one. There are different types of correlations. One is a positive correlation where two different assets will move in the same direction at the same time. And we'll take a look at that. And there is the negative correlation where the two assets will move in the opposite direction to each other. So first thing that we'll take a look at are interest rates. So we have covered this previously, but let's just do a quick review here. Interest rates are very, very important, especially in these days where the different central banks are raising rates. We saw Bank of Canada raise rates. And the big relationship between interest rates and the currency is that if interest rates go up, then the currency will go up. And if there's the expectation of interest rates going up, then the currency will start to move up. So people will start buying that in anticipation that the interest rates will go on. So that's very important to remember that as interest rates go up, the currency will go up in strength as well. Now, there will be times when the central banks will do what's called a dovish rate hike. And we have been seeing examples of that. A dovish rate hike is when the central bank will raise rates. However, then they come out and say that their outlook for the economy is not very good. So we saw Bank of Canada do that. We have seen Fed do that in the past. We have seen Bank of England do that as well. So basically they come out and say, okay, we need to raise rates now, but looking out into the future, into the next year, couple of years here, we are expecting the economy to slow down, or we're expecting the growth to slow down. So what that creates are two different basically feelings in the market. One is that the interest rates have gone up, which means the yield on the currency, the interest somebody will get on putting their money into the bank will be higher. So that is a positive thing, but it also creates this anticipation that they are not going to raise rates, that the central banks will not raise rates, the economy is not going to do as well. So this creates this positive as well as a negative expectation in the market. But overall, interest rates have a positive correlation with the currency. And the reason for that is when we have high interest rates, then more investors are interested in investing in that currency, in that country. And as a result of that, more investors want to buy that currency in order to invest in that country. And that's why we get a stronger currency. And as a result of the interest rate differential between two countries, we can also have an opportunity of a carry trade where we can sell a low yielding currency. So we have a currency or a country where the interest rates are really low, and we can sell that against a country or the currency where the interest rates are high. So right now, for example, Japanese yen versus US dollar. US dollar has higher interest rates. Japan has low interest rates. So we won't go too much into carry trade. This is a topic that we can cover at a different time, but that's called the interest rate differential, and it can lead to a carry trade strategy. Okay, the next one that we'll take a look at is oil. Now, this is, again, we have talked about this at different times, but since we are talking about different market correlations here, this is an important one to mention. As Forex traders, it is important that we pay attention to what the oil is doing, especially if we are trading Canadian dollar. So Canadian dollar and oil are positively correlated. In this case, if oil moves up, generally the Canadian dollar will move up as well. If oil goes down, generally Canadian dollar will go down as well. And the reason we have this interrelationship or positive correlation between these two currencies is because Canada is a big oil producer. Canada exports oil, it's a big oil producer. So when price of oil goes up, Canadian dollar does well because there's more money being generated. Whereas when oil goes down, Canadian dollar will go down as well. And this is a relationship that we tend to see a lot. So let's take a quick look at our charts, and I will show you that. So if we go into our charts here, let's go to dollar CAD. So dollar CAD has been going up. Now, keep in mind that dollar CAD also has a relationship with the US dollar. So if US dollar goes up, dollar CAD will go up as well. But if we look at it from oil perspective, so when we go to our oil chart, you will notice that when dollar CAD goes up, so oil will actually be dropping. So here's our oil. So we see that oil had these big drops here. And if you were to go to our dollar CAD chart again, give me a second as I scroll back on my charts here. So here's our dollar CAD. So we see here oil dropped, pulled back, dropped, pulled back, and did another drop. And now it has been going sideways here. So if we take a look at the dollar CAD here, we also see a similar pattern where dollar CAD was going up, pulled back, went up, pulled back, and it has gone up again. So Canadian dollar and oil are positively correlated. When oil drops, Canadian dollar will drop as well, which means dollar CAD will move in the opposite direction, because in this dollar is the first one. So that's where, so US dollar will get stronger as Canadian dollar weakens. So when oil drops, dollar CAD goes up. So that's what we want to remember. And when oil goes up, dollar CAD will drop because Canadian dollar will strengthen. So there's a positive correlation between Canadian dollar and our dollar and oil, sorry. So positive correlation between the two. Now, if we take a look at this chart, this is a chart of oil versus Canadian dollar, old chart here from 2000, 2001, but we see that there are times when this relationship can be broken, but generally this tends to be, this is a chart from 2000 to 2011, sorry, not 2001. And this is a positive correlation between oil and Canadian dollar, which means it is an inverse relationship between oil and dollar CAD. So they will move in the opposite direction. So oil and Canadian dollar move in the same direction. Oil and dollar CAD will move in opposite direction because US dollar is the first pair of the currency. So that's what we are going by. So as we see here, as oil goes up, dollar CAD will go down because Canadian dollar strengthens. So from time to time, the relationship may break, but overall, the relationship stays the same. So oil and dollar CAD are inversely related. Oil and Canadian dollar are positively correlated. That means oil and Canadian dollar will move in the same direction. So it's important to keep that in mind, because if you are looking to trade Canadian dollar, you want to pay attention to where oil is doing. And if you trade oil futures, there may be an opportunity to trade dollar CAD as well. So that's what I like to look at every day when we do our analysis. That's why we look at both oil and dollar CAD, so we can draw those conclusions based on the market correlation there. And here is a chart of dollar CAD. So we see that as oil was going up, dollar CAD here has been dropping as well. So we saw that on the chart. So let's move on to the next one. The next one is gold. Now, gold is another commodity currency. We have talked about this previously as well, but again, a quick refresher here. Gold and Australian dollar have a positive correlation here because two of these move in the same direction. And the reason gold is correlated with Australian dollar is because Australia is a big producer of gold. Australia is a resource economy, so they produce a lot of, they mine a lot of stuff, so different commodities, copper and so forth. So because gold is, again, one of the safe haven currencies, safe haven assets, when gold is going in a certain direction, you'll see that Australian dollar will tend to move with that as well. So this is another one that we want to look at. And that's why, again, in our daily analysis, when we take a look at Australian dollar, we always look at gold as well, so that we can draw those conclusions based on the direction. And when things are broken, it's best to not trade them. It's best to leave them. But generally, you will see that there's a positive correlation between Australian dollar and gold. So here's a chart that shows correlation between Australian dollar and gold. We see that Australian dollar is here in the blue and gold is the other, the red one here. And both of them will move in the same direction. So because Australia is a big producer of gold, so if something happens in Australia where the mining is not going so well, we will also see that Australian dollar will be impacted by that. Or if there is a risk in the market and we see that gold goes up. So gold, like I said before, because it's a safe haven currency or safe haven asset, when gold goes up, we'll see that Australian dollar will go up as well. So it's important to pay attention to these correlations because there are opportunities that we can take advantage of based on these interrelationships. And here's another chart that shows, again, from 2000 to 2011 here, shows the relationship between gold and Australian dollar. We see that as gold goes up, Aussie dollar goes up as well. So they are positively correlated, and hence it's important for us to pay attention to both of those when we are looking to trade either one of them. Let's talk about an inverse relationship now. And we see that US dollar and gold will have an inverse relationship. And what happens is during the times of risk aversion, when investors are not very excited about taking risk, we see that gold will go up, but US dollar will go down. So this is another relationship that we can pay attention to if we find that stock markets are not doing so well. Overall, there is this big risk aversion where investors are concerned and they're scared about investing in high risk assets like stocks. Then we'll see that they tend to go towards safer assets like gold. And as gold goes up, we tend to see that US dollar will go down. So that's another relationship that we can pay attention to and we can take advantage of. So when we trade, as traders, we have to be flexible in our approach and we have to have this bigger view of the market. So that's why we can't just look at one currency or two currencies. We have to just see what's going on overall, what's going on in the overall market and where is the opportunity that we can take advantage of. So here, when we see these different assets moving, we can then draw inferences from that, and we can trade our Forex pairs just based on those interrelationships. So it's important for us to just get that extra knowledge so we can actually take advantage of the opportunity. All right, so now let's take a look at stocks. Because the stock market has been dropping, this is a good time for us to talk about that relationship between stocks and different currency pairs. So a first one that I want to talk about is the Japanese yen. Because Japanese yen is a safe haven asset, like we talked about gold, Japanese yen and stock markets tend to move in the opposite direction. So when you see stock markets tumbling, it's a good idea to take a look at what Japanese yen is doing, and you'll notice that Japanese yen may actually be strengthening because it is a safe haven asset, safe haven currency. We see that investors will go out of the high risk assets like stocks, and they will go into safe haven assets like bonds, Japanese yen. So those are two other ones. So Japanese yen is one that we want to look at when we are looking at stocks. So if the stock market moves up, then the pairs that we want to be looking at would be your normal US dollar crosses like Aussie dollar, New Zealand dollar. Those generally will move up. Euro will tend to move up. Euro yen will drop actually. So any of the yen crosses we want to be paying attention to, because when the stock market is doing really well, yen crosses tend to not, yen does not perform too well, which means the yen crosses will do well. So pound yen, euro yen, all of those currencies will actually do well. And euro is also a risk currency. So when risk is, when investors are taking risk, then euro and pound will tend to go up. And we see that when stock market is going up, things like dollar CAD will drop, and euro Aussie is likely to drop, and pound Aussie are likely to drop, because Aussie and New Zealand will tend to do well when the stock market is going up. And when the stock market is going down, we see pairs like dollar, Aussie dollar, New Zealand dollar, euro yen. These currencies, these pairs will go down. All the yen, most of the yen crosses, I should say, actually, will tend to drop when we have stock markets dropping, because it creates a environment of risk aversion, which means more people will be going into Japanese yen. That means Japanese yen will strengthen, and that's why Japanese yen crosses, euro yen especially, and pound yen will drop. So this is what we've been seeing in the market just recently, is that euro yen, pound yen have taken a hit because yen has been strengthening. And we tend to see that dollar CAD, we have seen dollar CAD go up, and we have seen Aussie dollar go down. We have seen pound, euro dollar go down as well. And we generally tend to see these type of relationships. So just look at when the stock market is doing poorly, look at yen crosses, because that's where the opportunity will be to trade. And then just different correlations between different Forex pairs. So euro dollar and pound dollar are positively correlated. We'll generally see that euro dollar and pound dollar will tend to move in the same direction. And when we see that one is moving and the other is not, it's a good idea to go take a look at euro pound, because that's where the trading opportunity will be, because generally euro pound will be moving at that time. And a lot of time we see euro pound just tends to go sideways, doesn't do a whole lot. That's because euro dollar and pound dollar are positively correlated. They tend to move in the same direction. And generally we'll see the mirrored pairs here will be the dollar Swiss franc, and dollar yen and dollar Swiss franc are also positively correlated. When we see dollar yen move in one direction, it's a good idea to go check out dollar Swiss franc, because again, they will move together, because Japanese yen and Swiss franc are both safe haven currencies. So they tend to move in the same direction. So especially when the stock market is being impacted like it is right now, so stock market's going down, good idea to look at Japanese yen and Swiss franc. And so if you see that dollar yen is dropping, you'll generally notice that dollar Swiss franc is dropping as well, because both Japanese yen and Swiss franc will actually be strengthening and hence causing the rest of them to drop. So pay attention to those two there. And like we said, if you see pound dollar going up, then euro dollar will tend to go up as well. And Japanese yen will mirror that, dollar yen, sorry, will mirror that move as well. That's it for today. Have a wonderful weekend, and I'll see you next time.
Thanks for joining us today. With much gratitude, your show host, Raman Gill.